Hi, my name is Alan Bush, and I am the Senior Financial Futures Analyst here at Archer Daniels Services. Let's start out with the stock index futures. We have seen a tendency this week for futures to perform relatively well in spite of mostly bearish global economic news. Even though we are seeing futures a little bit lower today, I'm getting the feeling that we will see a pretty good recovery from these modestly lower levels. And the reason for the recovery quite often, many days this week, is that there's a growing feeling that there is more accommodation coming from one or more of the world's major central banks, including the Fed and the European Central Bank. Keep in mind, we had the Danish Central Bank cutting rates. Quite often when one country in Europe cuts rates, others follow. So there's an excellent chance that within the next couple of months, we will see the European Central Bank cutting rates from their already record low 1%. So all of this is supportive to global equities and, of course, U.S. Stock index futures overall. So from here, I would look for higher prices in stock indices and a move from the current lower levels that we're seeing to higher levels on the day and higher prices longer term. Over in the currencies, we have the euro currency now falling about 5% against the U.S. dollar this month. There was some temporary strength overnight when the Italian Prime Minister said Greece will not leave the Eurozone. Nobody is really believing that very much. There seems to be a growing chance that, in fact, Greece will leave the Eurozone, possibly after their elections, June 17th. Also, later in July, they could be running out of funds to pay their bills, so it's looking more and more like Greece will be exiting the Eurozone, all of which is bearish the euro currency. Also, we remain bearish on the Australian dollar and the Canadian, with the Canadian dollar under some pressure with a railroad strike in Canada now dragging on for its third day. The bigger picture is that the global economy is weakening, and that will hurt the commodity currencies, the Australian and the Canadian. Credit markets holding up well. All these problems in Europe are supportive to that market. Prospects of easier credit globally also supportive. So we would expect higher prices from current levels for the treasury markets. These are my opinions alone and not the opinions of ADMIS or Archer Daniels Midland.